Segment, we're going to take a look at an actual stock and evaluate the metrics that come with it that the tool provides, both performance metrics and financial metrics. So to begin with, I'm going to input a couple of stocks. We're going to pick Adobe and we're going to pick Boeing just for contrast. And immediately you can see one is all green, which we would call good. One is all red, which is not so good. If you take a quick look at the radar screen, we don't have the percentages on here, so ignore that. But when you look at the individual, Boeing is as you get about the same return as the SPY, but look at that volatility, 42% volatility. So it's way off here and really near the danger zone that with it being all red. If you're a value investor, you may be interested, but the rest of us are saying no thanks. The metrics don't pass the test. Adobe being all green is way up here where you would expect it to be. So let's take a look at Adobe, and simply by clicking on the ticker symbol, it pops up a screen that will give you your financial metrics. And so we want to go through and explain the rationale and how you evaluate this. The main one that you look at is this first segment, and it is showing the last 4 years revenue, earnings, and free cash flow. You want these all to be going up, and you want the free cash flow to be very positive. So as you would expect with an all green stock, these are very good. Many, or some at least, of the all green stocks will show revenue growth, but maybe not earnings growth and negative free cash flow. Those would be much riskier stocks and not ones that I would recommend, but some people take chances on those. But at least we give you the information here and the data to make the decision on what you want. In your investor profile, as we talked about in the earlier segment, as you roll from your investor profile to define your investment policy statement, you may have some certain statements in there about that. For example, my individual investor policy statement says that I will only invest in stocks that have positive free cash flow and the 4 years of revenue growth and earnings growth. So this one snapshot is huge to me because of that. When you hover over it, you will see not only the revenue number, the earnings number, and free cash flow, but you'll notice in green, it's the earnings to revenue ratio. And as you would probably expect with a mainly software company, the earnings to revenue ratio is pretty high. They don't have a lot of sunk costs and those kind of things that they have to cover. Compare that to a Walmart that's in a single digit earnings to revenue, kind of, just to give you an example. The other thing we want to look at is the analysts' earnings to what is explained to analysts as what we expect to be earnings the next quarter versus how they really come out. So the earnings estimates become important. And as you would probably suspect, the green is we've beat the estimates, and if there was a red one, it would say that we missed it. These are all green, and you can see the clear circles or white circles are the projected or estimated, and you like to see those going up as well. So all green, meaning we're beating the estimates on a regular basis and the estimates are improving, is the ideal chart. And so you're pretty much looking at ideal charts here in both these cases. In the next part, we also want to take into account the analyst recommendations. So a quick show of this is the consensus analyst rating is Adobe is a strong buy. And then compared to that, what we do is we look at the last year's price chart and the projected price estimates for the next year by these analysts. So you can see here, they're all projecting, even on the low end, they're projecting an improved stock price. Not by much, but it's still there. So you can take a glance graphically and look at this, and you see the average versus the high and the low. And those are projected down here in percentages. So even the low one says they're going to have a growth of 1%. I personally tend to take a midpoint between the average analyst recommendation and the high. I don't like to take the low. There seems to be a bear in every group, and you want to be cautious of just taking the high. because that can be an overly optimistic one as well. You may choose and land on the average. I tend to choose the midpoint between. But again, data's here. You decide what fits for you. I like to use this price range to get a good understanding in my own head as to when it's a good buy and when to enter the market, because I can see what kind of growth there is. So that was pretty huge too. And then institutional holdings, you like to know what that is. The main thing from institutional standpoint, these are the money managers, right? And you like to have a significant institutional ownership. Most people will recommend 70% plus of institutional ownership. One of the nice things about that is institutions tend to be long-term buy and hold, which translates to less volatility to the stock. There's not a lot of panic selling, that kind of thing. So it minimizes the volatility in a very positive way. This increase-decrease position barometer here measures existing money managers, how many have increased their positions versus how many have decreased them. Now, depending on the market situation, this may or may not be a very significant thing. For example, money managers here have slightly decreased their position. In my estimation, all this is saying is the market, Adobe stock has gone pretty high, so some people are trimming some of those profits and rebalancing their portfolios. So this is very neutral to me, and almost positive, so I'm okay with that. This one over here might be the better, but again, we like to give you all the viewpoints and different lenses to look through. Over here, it's how many money managers who did not hold a position are now entering into positions. And so you can see there's a whole lot more green. And the exiting positions is a statistic that says an existing money manager has totally exited this stock. In fact, they sold it all, removed it from their portfolio. And as you can see, not very many of them have done that. So this is a pretty nice one to take a look at real quick. Last but not least, we just put a little blurb in there about the Adobe company itself so you can get a feel for where it is if you don't already know it. So that's your quick flash through the financial metrics. So I can close this and we're back to our normal screen here. I do want to talk about the financial metrics pretty quick. In the initial segment, we talked about what I consider the cornerstone factor, which is the upside downside capture. I'm going to go ahead and make this 100% so that you can see it up here in the big numbers. And so as we discussed in this earlier one, the type of investor you are, whether you're conservative all the way to aggressive, will guide you into what the decision as to which stocks or funds you want in your portfolio. So this is the cornerstone of the entire philosophy as far as I'm concerned. When you come to the next one, this compound annual growth rate over the standard deviation. So this shows you over the last 5 years what's been the earnings of this company. And I think we all know the standard disclosure, but to make sure it's clear, just because it did well over the last 5 years does not mean it's going to do well in the next 5. So you can never really do that, but certainly the ones who have a 5-year good track record have a higher probability of continuing that in the future, especially when you compare that to the financial metrics that we just talked about. So keep that in mind and kind of decide on your own here. The standard deviation is just the volatility, both positive and negative, of the stock. So a lot of times you may want to build your portfolio based on, I don't want anything that moves around price-wise. So I want 10% or less standard deviation. I don't recommend that because a lot of people call that risk by definition. There's a very real difference between risk and volatility. Risk is more, and you'll hear a lot of sequence of risk. And it's really about the chance of a stock being really low priced when you need your money. So you have to sell low, which is what you want to avoid. But if you're a long-term investor, that risk really is off the table, and you're really just talking about volatility. And volatility tends to work for you going forward. But that's an individual call. Again, we give you the data, you decide. Everything we do to make it green, if you look at the bottom here, the ratio of 1.00 is acceptable. That would be yellow. Ratio of 1.25 plus is desirable. That turns it to green. So you want your compound annual growth rate to exceed your standard deviation. If not, it turns red, as you can look down here. Boeing has a 16% compound annual growth rate for the last 5 years, but 42% volatility. That's inverted, and you really don't want that. So anything less than 1.00 would be red. So caution big time, right? If you go to the next one, we include alpha. A lot of people care about alpha because if your goal is to outperform the index, alpha is saying how much this stock or fund is outperforming the index. So it's a really nice alignment with that goal. And as you can see, Adobe in this case is outperforming the S&P 500 by 22%. So that's a pretty strong alpha, believe me. The Sharpe ratio, there's a lot here that you can read, but essentially we included the Sharpe ratio because a lot of financial analysts, a lot of companies will sort by that, will look at it. And essentially, the Sharpe ratio is a risk-adjusted return based on how much volatility there is, and it really bases it on the standard deviation. So anything above 1 is considered good. We make it green, if it's above 1. So you can see that. So the Sharpe ratio is 1.59. The ratio that I prefer is the Sortino. So the Sortino, as you can see, is higher. And the Sortino is basically the same ratio with the exception that it doesn't penalize you for upside volatility. So if your stock goes up, and up and doesn't go down much, on the Sharpe side, that ratio won't look so good because the upside is volatility as well. A standard bell curve, if you will. The Sortino only looks at what is it from a positive versus a negative, but you're not punished if the positive is more. And so we really like to see a Sortino ratio of 2.0 or higher. And as you would expect from everything you've seen here, Adobe at 3.32 is pretty wonderful. And I just want to show you one last thing because that shows you what the metrics look like. But I want to click on Boeing and show you real quick. Just look at this and a quick idea with Boeing being in the red. It's got negative cash flow, negative earnings the past year. So it's really depressed. I think we all know the Boeing story. And so we're probably not surprised by that. But I want to show you just the difference in the contrast between them and how ineffective management has been in projecting what their earnings estimates would be. They continue to be very positive and keep talking it's good, but not delivering on those results. So just wanted to show you that real quick. This segment we're concluding. Just as a reminder, we looked at it. When you click on it, you can get the financial metrics, and here you can look through the performance metrics. And between both the performance metrics and the financial metrics, and part of the financial metrics being analysts' opinion and projections, you have a real good quick snapshot of an individual stock or fund and whether you want to consider it or not in your portfolio.